Good morning, everybody, and welcome to this particular session, TFT Education Series. And today we are looking at the concept of more details in terms of the liquidity concept. The real reason why stops get hunted, right? So, like I've always emphasized, the key three things that you really need to understand is the structure. You need to understand liquidity, and also understand time. Okay, so those three aspects are very important when it comes to trading. So when you talk about liquidity, so what I will say about liquidity is that basically this refers to the or availability of buy and sell orders in the markets. And for every buyer, you need to realize that there has to be a seller. Like I've always said, trading is a zero-sum game, whereby if there are buyers in the market, there has to be sellers in the market, so that a transaction can be able to take place. And now you realize, because now for the big institutions, they usually have or place huge orders, it might be difficult for them to get an opposite side of their transaction. Maybe probably if they're doing a buy, it might be difficult for them to get maybe someone who is placing a sell. Why? Because they're trading huge volumes, and therefore that's where the aspect of liquidity comes into place. They have to engineer liquidities so that now they can get their orders activated in the markets. Okay, so that is very important for you to understand. So in this particular video, maybe how I'll say is that if you ever felt like the market hunts your stops or your stop loss before moving in your direction, you're not imagining the movement, but you may be maybe probably misunderstanding the reason. And traders often blame brokers, manipulation, or bad luck when their stops get hit. But the reality is simpler. That it's very simple and actually more important to understand. And that's what I'll be doing in this particular video, breaking down what liquidity actually is and why price moves towards stop loss clusters before making its real moves. I know previously I've done some recordings, a couple of them, in terms of liquidity, but in this one is basically maybe probably adding some more lipstick or giving some more insights or adding up into the videos that I've already done. So maybe to get the tone or to get the mood set, what you need to understand, if you're this kind of a trader who constantly gets stopped out before the price move happens, maybe this kind of a trader who feels like the market knows where the stops are, this kind of a trader who maybe probably struggles to understand why price spikes beyond key levels, or maybe probably this kind of a trader who wants to finally understand how liquidity drives price, then this particular video is for you. So why liquidity matters, you have to understand that stops, they don't get hunted because the market is unfair. Stops get triggered because they provide the liquidity, and liquidity is what actually allows large orders to be filled in the market. So the reason why you need to understand that large institutions cannot place huge orders or huge trades instantly. They need cluster of orders to fill positions efficiently. And these clusters are often created by now the retail traders, me and you. So the reason why now we need to understand this and start thinking like, the institutions, how they trade, so that we can be able to align ourselves, so that we can be able to avoid has being the liquidities. Okay, so and one thing that you need to understand is where does this liquidity exist? So, okay, so for you to be able to understand these liquidities, where they exist, I will put it this way, or I repeat the statement that I began with, that liquidity simply means availability of orders in the market. And that for every buyer, there has to be a seller. And for every seller, there has to be a buyer. Okay. So, and large institutions cannot enter massive position without enough opposing orders. So if a bank wants to sell a huge position, it needs buyers. So where are those buyers most concentrated? Often at obvious levels. And which are these obvious levels? Above resistance, below support, at equal highs or equal lows, breakout zones and where the stop losses are clustered. So because these areas, they contain liquidity, and price will move towards those particular liquidity. Okay, so and the reason why now you need to understand why stops get triggered. Retail traders, they place stops in predictable places, the ones that we have talked about: above swing highs, below swing lows, just maybe probably outside support and resistance. Okay, but for the smart money, they use this particular concept basically to be able to place they use these concepts to be able to take out their or to place their TPs in the market, their targets. So they have their targets at swing highs, they have their targets at swing lows, and also those are the places whereby maybe probably they also have their orders. Okay, so these stops, once the stop loss now, because the retail mindset is placing stops above swing highs, below swing lows, or just outside the support and resistance, and you find that higher chances most of the time these stops they get hit and they become liquidity pools in the market. So they provide some context of liquidity. So and when you talk about the liquidity sweep, all right, when we talk about the liquidity sweep, basically what you need to understand is that a liquidity sweep occur or happen when price briefly moves beyond a key level to collect orders. Okay, so maybe probably to trigger stop loss and breakout orders before reversing. So for instance, price approaches a key resistance level, so traders place stop loss above that particular resistance. Okay, so and what happens? Price pushes slightly higher, and therefore triggering the stop loss buy orders or the breakout buy orders. So once those orders are filled, then we find the price reversing. We find the price reversing. Okay, so you have to really understand that particular concept. I'll be showing you some few examples here in the chat so that you can be able to understand what I am talking about. So, and what you need to understand, once those orders are filled, price may reverse. And that is not randomness. It's the market accessing the liquidity. Okay, that is the market accessing the liquidity. Okay, so it's important. All right, this is just one of the examples of how the liquidity sweep happens. Price approaches resistance, traders place stops above the level, stops triggers, that thing that happens, price breaks slightly higher, stops are triggered and liquidity enters. And then we see price reversing after orders are filled. Which orders are being filled? The orders which are placed by the smart money, or what you're calling the institutions. Okay, so and why these sweeps basically often happen before big moves, it's because liquidity sweeps help to fill institutional orders, they help to remove weak traders, they also help to balance market order flow, because again we always say that the market has to balance itself. So you have to understand the order flow, the balancing, the concept of the order flow is very important, and that's where the structure comes into place. And what you realize is that after the liquidity is cleared, price can now move more freely. Okay, once the liquidity is cleared, price can be able to move more freely. All right, so and as a trader, right, as a trader, you also need to understand that this is what keeps the traders now to avoid entering too early. So if you understand the concept of liquidity, because the previous video I talked about entering, why most of the traders enter the trades too early, because they don't understand. One of the reasons, they don't understand the concept of liquidity. So this concept of liquidity will help you now prevent you from taking trades too early, right? So you just wait for everything to align, and then now you can be able to take that particular trade, because after liquidity is collected, the path becomes clearer for price to move in it as its intended direction. Okay, so and how can traders use now the liquidity to their advantage? So instead of fearing liquidity, traders can watch for them. So the key ideas here is anticipate stop clusters around obvious levels. So you have to have that in mind. Expect temporarily break before real moves, and also wait for confirmation after liquidity is taken. So rather than entering the trade at the level itself, be patient so that you can actually improve the timing. You wait for the liquidity. For instance, you wait for the liquidity sweep, then you look for a shift in market structure or a change of market, a change of character, and then now you can be able to enter the trade once all those things are aligned, because you are aligning the structure, you are aligning liquidity, and also you are aligning time. Okay, so liquidity, therefore, it becomes a signal and not a threat. If you understand it well, it becomes a signal and not a threat, because it will signal to you this is what is likely to happen, and therefore you are able to plan yourself accordingly. So what are the key takeaways? You need to understand that liquidity is the fuel for the market movement. This is what drives the market, and price moves towards areas where orders are concentrated. So when you're analyzing, you need to look at areas where all those obvious levels where the orders are concentrated, and that's where you need to align yourself now in that particular aspect. Then you need also to understand that stop loss clusters create liquidity. Those obvious levels that each and every person want to put their stop losses at, those levels, it clusters, or those stop loss clusters basically creates the liquidity. Okay, so and liquidity sweeps, it clears weak positions before large movement. So anytime you see those sweeping liquidity, you have to anticipate maybe probably some larger movement of prices. So once you understand liquidity, then the market behavior stops feeling random. Okay, so in the next video I'll be talking about internal versus external range liquidity in a simpler way, so that you can understand where the market is likely targeting liquidity within and beyond the trading ranges. So for now, I will take you maybe probably to the charts, and I show you some few aspects of what I am talking about. So let me go to the chart, right? Let me go to the chart. Share screen, right? So there is my chart. I believe you can be able to see it quite visible. So let me put it there. Right. Yes, there is the chart. So what we are talking about is that there are these obvious levels. Like when you look at this particular point, this is an obvious level, right? It's an obvious level of resistance. This is also a very obvious level of support. Okay, and you can see how the price comes because for retail traders, they'll be maybe probably looking for buying opportunities at support levels. Okay, so what happens at this particular point, their stop loss will be somewhere below these levels. The price will come and take out the stop losses, and then now it starts displacing in the that upper direction. Okay, so stop loss, these obvious levels. You can see at this particular point also we have that stop being taken out, and what happens is that the price comes and takes out the stop loss, and then now it starts pushing on the upper direction. Okay, so you can see here also the liquidity, the session highs, the Asian highs there being taken out, and the price pushes on the downside. Okay, so you can see all these, right? So the key thing is to understand anytime we have this kind of liquidity sweeps, the price has to react on it. So you can wait now for confirmation, the liquidity sweeps, and then now you look for maybe probably in this case scenario, you can look for buying opportunities. Okay, same as in this particular case scenario here as well. So this is quite a lot of concept that you need to understand. So we have that liquidity being swept, and then we see the price pushing on the downside, and yes, we see all that particular perspective, all that particular parameters. You can see here again these obvious liquidity is being taken out, and the price pushes on the upper direction. Okay, so thanks guys, keep it safe until the next one. We'll be talking about the internal versus external range liquidity, and until the next one, keep safe. See you.